So is the market sending an all-clear signal on the economy and the policy path ahead? Or is it time again to start looking out for what might trip things up? Let's ask BlackRock's Rick Rieder. He's CIO of Global Fixed Income and head of the global allocation team there. Rick, great to have you.
Thanks
good to see you.
Yeah, appreciate it.
What's your read on what we're getting from the markets here? It feels like this is how the markets trade when kind of soft landing, risk has been mitigated, and people are kind of jazzed up by the opportunities and growth.
So I would add to that, you also have, you had this period of the markets were in the sense of stasis that people were concerned about. You had tariffs, you had Mideast, what was inflation going to look like? And some of those clouds, as you said, have parted. And then what is so clear is you look at the amount of cash that's sitting out there, we were looking at the total net worth of the size of the fixed income market, size of the equity market. Globally, there is so much money that wants to come into the market that didn't for a while. And I just think if you don't have any negative news, the natural gravitational pull is across all these assets. Plus, listen, when you look at the growth data, the growth data has been okay. And, I would argue the next couple of months you're going to slow a little bit, but not in a disappointing way or not in a stressed way. I don't think we're going into a recession. I think that's been taken off the table. And, inflation, the last 3 months, moving average of core CPI is 1.7%. It's okay.
Yeah.
So, can the Fed move? I think the Fed can move. Will they move in July? I don't think so. But the window is there that they could do it.
You've made the case over the years repeatedly that the U.S. economy it's just kind of hard to knock off track.
Yeah.
Right? It's a big service-based economy. Our companies are massively profitable. And therefore, if you're not going to get a shock, and maybe the shock of the tariffs, at least the threat of the tariffs didn't do it, maybe we're free of that for a while. But I do wonder what the market is now implicitly trying to price in here in the way of whether tariffs are really going to be a restraint on growth, whether it's going to be a little bit of a period of inflation cosmetically going higher, or if it's going to maybe create some other knock-on effects.
I would say one thing. I believe in this thesis that, by the way, it's like the best trade every year. It seems like sometime in the first or second quarter, people get horrified about we're going to go into recession or deep recession. And I just don't think service economies, which the U.S. economy is, I don't think that happens. Second thing is I think people don't realize you transferred so much money post-COVID from the public sector to the private sector. The reason why the biggest risk is the government holds the debt now. What happened was the private sector, corporations, individuals, financials delevered. So you have this ballast underneath you. You don't have a geared economy other than what's at the government. You don't have a geared economy. And then think about the same time you put all that stimulus in, the central banks kept the rate down at zero or in Europe at negative. So you actually created this explosive growth of wealth, corporate cash flow dynamics. You've termed your debt out. So the underlying foundation is pretty darn strong. So what trips it up, from here? Listen, I still think the tail risk is the government debt. That's where you're geared. And that's where, we got to keep doing a lot of auctions as you get into next year. I love the front end of the curve. I love the front to the belly of the curve. Out the curve, I'm not sure I need to be a big buyer out there at all. I just think you create a lot of income using the front to the belly and just keep ticking off income while the equity market will do its thing.
If the economy does have that cushion and that momentum on some level, is the Fed actually particularly restrictive here at 4.25 to 4.5? So,
I'll throw out something. And it seems like for years people said, gosh, if the 10-year gets to 3.5, if it gets to 4, if it gets to 4.5, it's over. You have an economy that's not interest rate sensitive. Companies, you think about who are the big drivers of AI, of CapEx, of R&D spend. They don't borrow. You talk about the big hyperscalers, et cetera. They fund through free cash flow. So the interest rate doesn't affect them. Banks are asset liability matched. That's not interest rate sensitive. And the consumer is largely delevered. So point being, with Fed raised rates 500 basis points, did the economy really break much? Not really. There's only one aspect. The reason why I think you can open the door to the Fed cutting is housing. The mortgage rate is too high. And there are a whole series of things that I think we should be doing as a country to incentivize home building. You look at, was it KB Homes this week? If the mortgage rate, the funds rate's high, floaters are high, the mortgage rate stays too high, we don't build enough homes because those companies have to subsidize the mortgage. And so what happens, you compress their margins, they don't build any houses. By the way, that's what would bring down shelter inflation, which has been the stickiest part of inflation. So I would argue Fed could bring the rate down even though you've got a bit higher. And I think what Chair Powell said, you're going to get some tariff transmission over the next couple of months into inflation. At the end of the day, maybe, and by the way, it's probably right. But then I think, listen, I think we got to take some of the pressure off the housing market so that, quite frankly, young people, et cetera, can move into houses. That's where I think the interest rate is the most effective.